Welcome to the core premise. What if the most common financial advice you have ever received, the well-intentioned guidance to go to school, get a good job, and work hard, is the very blueprint for a life of financial struggle? What if the path to security is, in fact, a trap? This unsettling question lies at the heart of Robert Kiyosaki's enormously influential work, Rich Dad, Poor Dad. The book presents a radical departure from conventional financial wisdom, and its central thesis, the core premise we will deconstruct today, is this: financial freedom is achieved not by earning a high income, but by acquiring income-generating assets. This requires a fundamental shift in mindset from that of an employee who works for money to that of an investor who has money work for them. Let us begin. Kiyosaki's argument is built upon the story of his two fathers. His biological father, the poor dad, a highly educated government official who, despite a respectable salary, struggled financially his entire life, and his best friend's father, the rich dad, a school dropout who became a wealthy entrepreneur. The difference between them was not their income, but their mindset and financial literacy. The poor dad's path illustrates Kiyosaki's first supporting argument. Most people are trapped in what he terms the rat race. This is a cycle of dependency where an individual's life is dictated by their paycheck. They work to earn an income, but that income is immediately consumed by taxes, debt, and living expenses. A pay raise, counterintuitively, often deepens the trap. Higher income leads to higher taxes and a more expensive lifestyle, a larger house, a newer car, which in turn creates larger liabilities and a greater dependency on the next paycheck. They work harder and harder, but their financial position does not fundamentally change. They are in essence working for everyone but themselves, for their employer, for the government through taxes, and for the bank through their mortgage and loans. If working harder for a paycheck is a self-perpetuating trap, what then is the alternative? Kiyosaki argues that the escape route is not found in earning more, but in understanding the simple yet profound language of money. This brings us to his second and most famous supporting argument. You must know the difference between an asset and a liability and acquire the assets. Kiyosaki dismisses complex financial jargon in favor of two brutally simple definitions based entirely on cash flow. An asset, he states, is something that puts money in your pocket. A liability is something that takes money out of your pocket. The poor and middle class spend their lives acquiring liabilities that they believe are assets. The most controversial example of this is the family home. While it has value, it is not an asset in cash flow terms because it does not generate income. Instead, it takes money out of your pocket every month through mortgage payments, property taxes, insurance, and maintenance. The rich, by contrast, focus their energy and capital on acquiring true income-generating assets, real estate that produces rental income, stocks that pay dividends, or businesses that operate without their direct involvement. The income from this asset column eventually grows large enough to cover their expenses, at which point they are financially free. Their assets, not their labor, pay for their lifestyle. Understanding this distinction is more than an academic exercise. It demands a complete reorientation of one's financial behavior. Knowing the difference is one thing. Acting upon it requires a change in your primary focus. This leads to Kiyosaki's third critical point. You must mind your own business. He draws a crucial distinction between your profession and your business. Your profession is what you do to earn a paycheck. You may be a teacher, an engineer, or a doctor. Your business, however, is what you do to build your asset column. The core mistake of the middle class is spending their entire lives minding someone else's business, that of their employer. Kiyosaki's advice is to keep your daytime job, but to use the income from that job not to buy luxuries and liabilities, but to buy assets. Your focus should be on building and strengthening your own business, your portfolio of assets. It is this business that will eventually generate the wealth and freedom you desire, making your job and the paycheck that comes with it entirely optional. And so we arrive back at our core premise. Robert Kiyosaki's Rich Dad, Poor Dad is not a get-rich-quick scheme. It is a fundamental re-education in financial thinking. The central idea is that the path to wealth is not paved with bigger paychecks, but with a disciplined focus on building an asset column that generates passive income. This is achieved by first understanding the critical difference between an asset and a liability, and then committing to minding your own business, the business of acquiring those assets. The ultimate goal is to escape the rat race, not by running faster, but by leaving the wheel entirely. For those who wish to explore these concepts in their full depth, I have included links in the description below to purchase Rich Dad, Poor Dad. Doing so is an excellent way to support our channel at no additional cost to you. Thank you for your time. I hope you will join me again at the core premise.